Charitable deductions live on Schedule A, but the exam cares about two filters: who you gave to and what you gave. Public charities are your typical 501(c). 3 organizations like churches, schools, and nonprofit hospitals. Other groups, like certain private foundations, veterans groups, and fraternal societies, can trigger tighter limits. If you misclassify the recipient, you'll apply the wrong AGI cap. Now the big 4 AGI limits: 60, 50, 30, and 20. The 60% limit is cash to public charities only. The 50% limit is most non-cash gifts to public charities. Think clothing and household items. The 30% limit commonly hits appreciated capital gain property donated at fair market value, like long-term appreciated stock. And the 20% limit is the harsh one: appreciated capital gain property to many private non-operating foundations and other 30% organizations. Here's the exam trap. Appreciated property can change the limit even when the charity is legit. Donate appreciated land or stock to a church, and you're often at 30% of AGI, not 60. Donate that same appreciated stock to a fraternal benefit society, and it can drop to 20% of AGI. On the EA exam, they love giving you a good charity and hoping you ignore the property type. When the AGI limit blocks part of the deduction, you don't lose it immediately. You carry it forward up to 5 years. After that, it expires, and carryovers keep their original character. So a 20% limit carryover stays a 20% limit carryover in later years. Practically, that means you can't upgrade it into a 60% cash bucket later. What counts as a charitable contribution? Cash is easy. Non-cash has 2 big rules. It must be in good used condition, and the deduction is generally fair market value. Think thrift store value, not what you paid. You can also deduct unreimbursed out-of-pocket costs for volunteering, plus mileage at 14 cents per mile. But you can't deduct the value of your time, even if you're a highly paid professional. Also know what does not count. Payments to political groups, social clubs, chambers of commerce, and gifts to individuals are out. And quid pro quo is huge. If you pay a charity and get something back, you only deduct the amount paid over the fair market value of what you received. Charity auctions and fundraising dinners are classic EA exam setups. Vehicle donations have their own weird rule. If your claim deduction is over $500, you generally deduct the smaller of the vehicle's FMV on the donation date or the charity's gross sale proceeds. You need Form 1098-C, and if you don't attach it, your deduction is capped at $500. 2 exceptions let you use FMV. The charity keeps and uses the vehicle, or it gives it directly to a needy person. During a fundraising auction at his local church, Derek pays $800 for a week at a beachfront hotel, where he spends his vacation in August. He intends his payment as a contribution, and all the proceeds go to help the church. The fair market value of the stay is $750. What is Derek's charitable contribution? Think about it. The deductible charitable contribution is $50. This is a quid pro quo payment. Derek paid $800 but received a benefit worth $750. Only the excess is deductible. The tempting wrong answer is $800 because it feels like all proceeds go to charity, but the IRS subtracts the value of what you got back. Diana is 80 years old and has a traditional IRA with a required minimum distribution. She makes a tax-free gift directly from her IRA to her church. Her AGI is $80,000. What is the maximum amount she can withdraw from her traditional IRA tax-free as a qualified charitable distribution, a QCD? Think about the annual cap. The answer is $100,000. A QCD can be excluded from income up to $100,000 per year when it goes directly from the IRA to a qualified charity, and it can satisfy the RMD. The tempting wrong answer is $80,000 because people confuse the limit with AGI, but the cap is a fixed $100,000.